Hello, welcome to the Contrarian Capitalist podcast. I'm delighted to be joined today by Ronnie Stoeferle, fund manager, author of Austrian School for Investors, and also the In Gold We Trust report. Ronnie, how are you today?
Very well. Thanks for having me, Robert. It's a pleasure.
Yeah, really looking forward to this. And I thought it would be a good place, or in this podcast episode, to touch upon the basic fundamentals of gold again, because I see there's a lot of hysteria out there in the markets, not necessarily gold itself. So I thought we'd touch base on that. But I wanted to start with seasonality, if that's okay with you, because this time of year is normally quite strong for gold, if I'm not mistaken. Is that correct?
Yeah, that's correct. I would say that the best season for gold is between now and I would say like early summer, beginning of June. That's like the sweet spot for gold. We did a big chapter on seasonality in our previous In Gold We Trust report. We will have another one regarding some other seasonal drivers of gold for the next In Gold We Trust report that will be published on May 15th. And I always think, Robert, that seasonality, it's not the crucial driver from my point of view. So I wouldn't make investment decisions just on seasonal factors. But I think it's an interesting additional tool that you have. So we crunch the numbers, for example, for the monthly data, but also the average daily returns. We did the same with the turn of the month effect, the Halloween effect, and so on. So I think it's pretty interesting. But there's one caveat. Unfortunately, those seasonal patterns, they tend to change. So it's unfortunately not that easy just invest based on seasonalities. But one thing, as we're coming to an end in this year, actually, um, I think that the tax loss selling season for especially for mining stocks, for smaller mining stocks, is a very important driver, and we can tell that there's quite a lot of downside pressure in many of the smaller names. And usually the best season then begins at around mid-December. So I would say from a seasonal point of view, I think for some of the small cap names, the next couple of days could be really a very, very positive a window of opportunity to start allocating.
In terms of gold allocations, it's a question that I get quite a lot, and I'm not here to offer independent financial advice. I don't have the right licenses for that sort of stuff. But different people or different companies might recommend different percentages of bullion allocation. Do you have any particular views on that at all?
Well, the thing is, gold is a very, very emotional topic, and everybody thinks that he has an opinion on gold, or that he has to have an opinion on gold. Sometimes it's not very educated. I would say there's some analogies with Bitcoin, for example. I hear the same old points of criticism regarding Bitcoin for 10 years now. Um, and therefore, for us as asset managers and researchers, it's important to really crunch the numbers, present a sober and fact driven, numbers driven case for gold and also for Bitcoin. And that's I think really what differentiates us from many other players in the gold space. So we just put out a special report on the optimal gold allocation, where my team basically analyzed academic studies regarding gold allocation, and then we crunched the numbers based on our data set. And we found that between 14 to 18% gold allocation really improves the Sharpe ratio of a so-called balanced portfolio. So kind of a standard portfolio, 14 to 18%. So is that a lot? I would say yes. In the Western world, it's people will say this is way too much, while in many emerging market countries, people would say this is not enough. And I think this is also something that we described in this year's In Gold We Trust report called the new gold playbook, where we said that actually the marginal demand is actually nowadays coming from emerging markets. So the Western investor in Canada, in the US, in the UK, in Germany, isn't that important anymore. It is rather the physical demand coming from emerging markets, particularly China, India, and the Mid East. And for those regions, I would say inflation is something that has always been more of a concern, something that is really the starting point of every discussion about portfolio construction. And therefore, I would say that going forward, if inflation and especially inflation volatility should remain to be a topic, then I think that gradually we will see rising allocation in gold. And as I've said, 14 to 18%. That's actually, if I present that thesis in front of a Western institutional investor, he would just shook his head. This is just way too much. Most people would say, nah, 1 to 2% gold allocation. But then on the other hand, that doesn't make any difference on a portfolio basis. And I think, gold is it's not the solution for all our problems, but it works in times of recession. It works in times of a weak US dollar. It works in a time of when inflation is a concern, with high inflation volatility. It usually works when we've got negative real interest rates. And therefore, this is the big surprise that even though real interest rates have risen, so the opportunity costs got bigger. Then on the other hand, the price of gold actually did tremendously well. So that was definitely one reason why we started talking about this new gold playbook. But again, gold is a very, very powerful hedge, but it's not it's not the solution for all our problems.
I think that's good to hear, and it's also refreshing to hear, because I think, as we both know, that everyone seems to need to want to have an opinion on gold, and people do treat it like that last bastion and in it's a be all and end all. But so it's refreshing to hear that it's got a position. This is roughly when it's going to work well. There might be times where it might not work as well in comparison to other asset classes, and again, that's just refreshing to hear. I don't normally like date stamping podcasts, but we're recording this on the 9th. I had to look at my calendar, the 9th of December. And the reason I'm date stamping that is that over the weekend, just gone, we have seen China, I believe, possibly announce some new stimulus, or certainly the central bank has resumed the purchasing of gold after a 6-month hiatus. Mm-hmm. And there's been a bunch of issues in Syria, which, could lead to all sorts of issues. Would you say that another good reason for having gold in your portfolio could be some form of war premium and doing what the central banks are doing, i.e., if they're buying, then it might make sense for us people to buy as well, because they might know something that we don't?
Well, people tend to enjoy criticizing central bankers, obviously. But then on the other hand, when it comes to central bank buying, everybody thinks, okay, let's do it like the central bankers do. So my take is that central bank buying definitely is one important driver, and this actually picked up in 2022 with the invasion of Russia in Ukraine, and then of course with the sanctions against Russia, and that was a wake-up call for many countries to start diversifying out of the US dollar, out of US treasuries. So since then, we are seeing that central banks actually pick up roughly 30% of global annual production, which is really significant. And we saw it in October, the biggest or the highest year-to-date purchases by central banks ever. So this trend definitely has momentum. Now, when it comes to all those geopolitical crises, yeah, well, Is Syria really going to impact the price of gold? I'm not sure. I would say it has some sort of a short-term effect on the price of gold, but it cannot really move the needle. It cannot really change the trend from my point of view. What you mentioned, China, I think that's highly relevant from my point of view. What we saw with the Politburo meeting in September, that was basically the whatever it takes moment for China. So if we go back to 2012 when Mario Draghi had his famous whatever it takes speech, at that point nobody knew actually that this little sentence would go down in history, and this would really become some sort of the the turning point, the pivotal moment of the euro crisis. And I think we're seeing something in something similar in China at the moment, where 12 months from now people will look back and realize, okay, these little announcements with further and further stimulus, this is really the sign for a significant shift that we're seeing out of China. So I think that's very important for gold, but I would say for the commodity complex in general. We're now currently setting up a new commodity fund because it's probably one of the most contrarian ideas going forward. And I just did a couple of keynotes at big conferences recently, and I said that probably one of the biggest drivers going forward for gold will be significant weakness in the US dollar. I think that could really be the driver. Obviously, President Trump's second term, it's gonna be interesting. It's gonna be confusing to some degree. It's gonna be chaotic. It's not gonna get boring from my point of view. But what Scott Bessent recently said, that was just in June 2024. He said that the US is at a unique moment at the moment, and over the next 4 years, he could see something like a global economic reordering. And if you listen to what Donald Trump recently said, he said, he's very, very concerned about the currency situation, as he called it, and he was referring to Japan and also to China. So from my point of view, Trump really wants and needs a significant weaker dollar in order to succeed with this manufacturing boom of the United States. So I think a weak dollar might be the most important driver for the price of gold going forward. But yeah, so that's one driver. And then I think the second thing is some sort of let's say a Liz Truss moment for the United States, where people will really start questioning the debt situation in the US. I think that we are pretty close from such a moment. So there are many important drivers for gold going forward. However, from my point of view, we're somewhere like halftime in this trend. So for the short term, to be honest, I'm not too excited. I think I don't expect really a breakout to 3,000 US dollars or whatever. I would say that we will see some sort of a sideways trading over the next couple of weeks, the next couple of months, actually. And I think at some point we will have to see that that the Western financial investor will have to start allocating in gold again. Because for now, year to date, even though gold is up 30% year to date, we've seen inflows into the global gold ETFs of 2.4 billion, which is ridiculous. So that clearly tells us that the Western financial investor hasn't participated in that party yet. I think they're basically waiting outside, seeing, okay, is it too late to join the party now? they feel kind of hesitant. And I think at some point they will get in, and this in combination with the weaker dollar will probably be the next drivers.
Thank you for outlining, I should say, all of that. So I think that's crucial for people to understand. And I know a multitude of listeners are either UK or US based, people from all the way around the world as well. But certainly most people that listen to this are from the West. And
Yes.
what I get from that, and from what you've just said, is that if we look at what is likely needed, i.e., a weaker US dollar and situations like that, we've got to look at what are the probabilities of that happening. And again, for what you said about Trump and what he has said and possibly outlined, to me, it's quite clear that there needs to be a weaker US dollar for a multitude of reasons. And if that is the case, then that just perfectly plays into, again, part of that new gold playbook. So I think that's incredibly importantly outlined what you just outlined. So thank you for that.
You're welcome.
In terms of gold, and you actually mentioned another contrarian play there, setting up a new commodity fund. Are you allowed to divulge any other information on that for now, or is that a wait and see, and you'll announce it when that's done?
No, I think that our approach is also when it comes to mining stocks. I started investing in mining stocks when I was still at the bank 18 years ago. And I can tell you it's not a long only asset class. It's not something that, as Andrei Costoliani famously said, it's something where you swallow some sleeping pills, then you sleep for 10 years and you wake up being rich. If you do that with mining stocks, it's not going to work. So my take is that you really have to be active. You have to understand the cycle, the monetary cycle, the liquidity cycle, the capex cycle. And this is what we do actually, not only in our new gold mining fund, where we've got a signal that is telling us when to play offense, when to play defense. And we're now doing something similar in the commodity space. So, I mean, commodities are a very complex and diverse asset class. Most of the indices are heavily influenced by the energy weighting. So therefore we've got a more diversified approach. And again, it's not a stubbornly, long only commodities, but really a very, very active approach. And I can tell you, based on the feedback that we get, it seems to be very contrarian. People couldn't care less. And there was an article in an institutional fund manager publication recently, and it showed the 10 largest commodity equity funds, and they together had assets under management of, I think, roughly 20 billion US dollars. And those are the 10 largest commodity equity funds. And I think that's quite telling. That's like the minute fluctuation, the share price of Nvidia, probably. Yeah. So I think there's still room to go, especially in an environment, where after being very eager to tear down walls for 3 decades, now everybody is building new walls, and those topics like de-dollarization, deglobalization, nearshoring. I think those big trends, big secular trends, they will definitely have an impact on commodity prices.
100%. I'd agree with that. And I know that people will invest in gold for, and I'm just going to sort of summarize. I appreciate time's precious from your side at the moment. There's many different reasons why you could invest in gold or purchase gold, buy and hold, whatever it might be. And a few people that I've spoken to do point and say that if there is some form of monetary reset or currency reset, if then if gold then gets revalued, I mean that price could be, I've seen anything from 5 figures to 6 figures, but that's not necessarily a sole reason to buy and hold gold. But if we're looking at probabilities, if there is a monetary reset, then that could be quite favorable if you are holding gold. But it's not the be all and end all of a reason. There are so many reasons why you would want it as part of your portfolio.
Yeah, well, I mean, being from Austria, we over here, but also, in Germany, we heard all those stories from our grandparents about, currency reforms. Yeah, I mean, we heard about, hyperinflation, and it was quite common to get like little gold coins for for birthdays or for Christmas, and I think those monetary reforms where the majority of people always lost, um, they are kind of ingrained in our monetary DNA, I would say. So it is something where I would say this is not, it's not something outrageous to call. They happen every couple of decades, and we had it, of course, with 1971. We had it with the introduction of the euro. Obviously, the I don't know how many centuries the British pound is around, but that's definitely um, that's not quite common. Um, so so I would say, let's say, a reorganization of our monetary framework. That sounds very diplomatic. I think this is something that can or will happen rather sooner than later. And actually, I think in these transition phases, that's actually where you need gold the most.
Mm.
Um, that's probably also the time where owning gold is the most dangerous. Let's face it, also from a tax perspective. But I think I don't know if Foa, so friend of another, or Fofoa said that. That's the mysterious blogger. He said you only need one revaluation of gold in your lifetime. That basically that's enough. And I agree, and I think, if we have a look at the statistics, most of the important countries or central banks, they own huge amounts of gold anyways, and their central monetary reserve is gold. Although they don't really enjoy talking about gold, it is still the monetary backbone of the majority of countries in the Western world. While in emerging markets, they are now really desperately purchasing gold to catch up to the levels that we're seeing. There was a tremendous report by the World Bank, put out, I think, in February, where the author recommended emerging markets to own up to 22% of physical gold. So I think, it's about a level playing field. It's about, being taken seriously. And I think the emerging market countries, they just don't want to play by the rules anymore that they haven't written.
Mm.
So I think they want to be taken serious, and I think that gold really plays quite an important role to get that, how would you say, that recognition, and also trust. And I think therefore it's also it has some sort of a symbolical character,
Mm.
and that should not be underestimated.
Again, I totally agree with everything you've just said. It would be great, Ronnie. You mentioned that the next In Gold We Trust report is due out in May 2025. I think it
Yes.
would be fantastic that once that's out, maybe we could touch base for round two and maybe go through elements of that. That would be, I think, fantastic. I appreciate time is tight for you. So if people do want to find you or find the In Gold We Trust report, how do people get hold of you?
Well, in goldwetrust.report is the webpage for the report. You can download all our publications totally for free. You don't have to register, you don't have to pay anything. We publish in German, English. We just put out the Chinese edition. We do have monthly chart books, the Gold Compass. We've got special publications like the Gold Beer Ratio, the Gold iPhone Ratio. And if you want to learn more about our investment funds, it's incrementum.li.
Perfect. And as a reader of all those reports, I highly recommend them, first of all. Secondly, I'll put all of those links into the show notes, Substack notes, etc., etc. But Ronnie, thank you very much for sharing your expertise. I think that's going to help a lot of people, and look forward to catching up in the summer of 2025.
Thank you very much, Robert. All the best to you. Merry Christmas and a happy and healthy, prosperous 2025. Thank you very much.